Good afternoon and welcome to the MANOLETE Partners PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Stephen Cookland, CEO. Good afternoon to you, sir.
Good afternoon. Thanks very much indeed to you and also to everyone who's found the time to join us today. Thank you. Yes, these are our report of the year ended 31st of March 2024. I'm joined today by Mark Taverner, our CFO.
Hello everyone.
What we're going to cover today is an overview of the company. I'm always very aware that some listeners are completely new to MANOLETE and even litigation funding. Others of you are pretty much experts. So I'll go through it as quickly as I can, but I do want to make sure everyone's up to speed. Then I'll hand over to Mark for the financial results. And then an important new information today was really our current trading, because we are now 5 months into the new financial year, what we call FY25, and then we'll move on to Q&A. So MANOLETE is a very focused litigation financing company. We only focus on insolvency and really UK insolvency. And we are by far the leader in our field. I'll come on to that in a second. And it is a unique business model when you compare it to the other listed funders, because we buy the claims. We're not the funder. We are actually the litigant, the claimant. We own them outright via what's called an assignment. And what we're doing, we're buying these off insolvent companies have gone bust. And the people who we negotiate that deal with are the people who've been put in charge by statute of those insolvent companies, so liquidators, administrators, or in individuals' cases, what's called trustees in bankruptcy. And as a group, we call those office holders. And by buying the claim, there are many, many benefits as a business model. It gives MANOLETE full control as if it was our case from day one. We get to conduct the case. We can contact the other side to see if they would like to sit down and settle the case. And around 97% of our cases end exactly that way. We can manage the costs and the strategy of the claims as well. And insolvency is the only area of law where this is permissible, and hence the focus on the sector. We've invested in many cases, 1,300. We completed over 900 of those, and the settlements that we've signed up on those aggregate to over £136 million over a 16-year period. The returns, as we'll see in a while, are very, very high. Internal rates of return 130%, return on investment 116%. And again, as you'll see on what we call our vintage table, this has been spread in a very granular way across many hundreds of cases. On IRRs, internal rates of return, when I was wet behind the ear, qualifying as an accountant and then into corporate finance with Coopers and Lybrand, I dealt with a lot of venture capital private equity funds, and over a kind of 5-year, 7-year period, the targeted internal rates of return were compounding at 25% per annum. So to see anything with triple-digit IRRs is really very unusual. The Insolvency Service is part of the government, and they track all the liquidations and administrations on a monthly basis. I'll explain this graph a little bit more detail in a second, but what we have got now in the UK after COVID is the highest number of what's called creditor voluntary liquidations since the start of 1960. Their numbers don't go back further than that. And these CVLs, as we call them, are by far the biggest part of the market. So just to look at that graph a little bit closer, for years and years, per month, the number of companies going insolvent. The black line in total, we're kind of up and down, 1,200 to just over 2,000. But then at the start of COVID, what happened was that the government introduced emergency, almost wartime legislation to temporarily suspend various key insolvency laws, and that had the effect of a very sharp decline, as you can see that kind of droop by that COVID-19, very sharp decline in the number of companies becoming insolvent. That lasted for 2 years. They said it was temporary and it was, it won't last long, but actually after every lockdown, every new variant, it was extended. That ended in April 2022 after a brief period needed for the office holders to investigate claims. As you can see, the number of insolvencies absolutely rocketed ever since, way above the pre-pandemic level. The one exception to that, to a certain degree, was what's called administrations. They form part of the graph, but a very small part of the graph. Now, this is administrations is usually the routes that larger companies go down to when they become insolvent. The office holders are kind of effectively running the company for a period of time, trying to sell it as a kind of going concern. Now, the administrations have taken a much longer time to get back to pre-pandemic levels. It's only really in the last few months, and bigger companies are going into insolvency, inevitably leads to bigger claims, and that theme will pick up as we progress. What we noticed in our own data, we reported this before, in the first half of this FY24, we just saw 9 sign-ups of £1 million plus cases, which we define as large, but in the second half that was doubled. So that really was being driven by these number of administrations coming back to pre-pandemic levels. Manolete is very much the dominant third-party funder. If you look at that pie chart here, that represents a whole of the kind of annual insolvency litigation claim market. About 2,000, 2,500 claims see the light today a year. The blue bit of the kind of Pac-Man is lawyers working on a no-win, no-fee case. And if you were to go back 10, 12, 15 years, the entire pie would be blue. But what's emerged over the last decade or so has been third-party funders coming along and buying the claims. And Manolete, of that yellow piece, is by far the biggest. 67% market share has been the latest estimate, and the closest to us is about 4%. On top of that, there's a publication called the Chambers Guide, which is held in very high regard by the legal and insolvency community. They started an insolvency litigation, a league table, if you like, 4 years ago. And the top band 1, the only company that's ever been there and has been every single year has been Manolete Partners PLC. Since the IPO back in 2018, we've built up a network of our own people, full-time, in-house lawyers from Edinburgh, Manchester, Leeds, Newcastle, Bristol, Cambridge, London, and then all the way down to Exeter and Southampton, of our own top-class, very senior insolvency litigators who work for us full-time. The head of that is Mina Horton, who has been with us for over 10 years now. And many of these, almost all of these lawyers joined us as previously partners in private practice. And in fact, 2 of them act part-time as deputy district judges, so they're very heavyweight experts in the field. The business mix, 2 points here really. I've said for many years that the portfolio will develop into pretty much 100% purchased cases, and these new investments here, 310, 1, 311. So this year's new investments were almost all purchase cases, which is great, giving us full control. And then above that, the kind of ring is the kind of cases that we call them the 7 deadly sins. So it's the same repeat insolvency cases in the UK against UK directors or insurance companies, what have you. that repeat day in, day out in our line of business. The route to market, very simply, a company becomes insolvent, the directors either voluntarily put it into liquidation, or the creditors wind it up at court. An IP is appointed, funding is sought, and then MANOLETE purchase the claim. Excuse me. We then go into what we call the funnel. So that inquiries come in. We then have two groups within MANOLETE to run tests past it. So number one is what's called the high net worth group. So no matter how big the claim is or how good the claim is from a legal merits point of view, these people are checking for us, have they got any money? If the potential defendants are living in a rented accommodation in a tiny little flat in Aberystwyth, the work stops there. They haven't got any assets. What's the point of any of this? If it does pass that, they go into the legal review run by one of these 15 in-house lawyers. They pass up a report to the investment committee, which is Mark, our CFO, myself, and Mina Halton, our MD, and we send out the offer. We reject about 70% of cases, and when our offers are sent out, 89% of the time they are accepted by the liquidators. So that gets signed up. On average, over these hundreds and hundreds of cases that we've completed, it takes about a year to complete the claim legally. So usually by signing a settlement agreement with the directors on the other side. And although a year might sound like a long time, if any listener here has dealt with the law or the legal process, a year is not a long time. It's an incredibly short time. And on average, again, across hundreds of cases, we then collect the cash from those directors over an average of a further 12 months. Now, that can range from everything paid immediately to the need to give people an extended payment period. But that is the average is 1 year. So just to remind you of that graph again that I put here in the top left-hand corner. If you just focus on the last quarter really of it, so just in the lead up to the COVID drop, so those were that was the whole liquidations market in the UK. And what is very striking is that the case inquiries that we have had in mirror that graph, the shape of that graph very, very well indeed. So in the run up to COVID, this business was growing at a rate of knots, kind of quadrupled in size in about 3 years. Then there was a very sharp decline because of COVID, the law changes. After that was put back to normal, we then recovered very, very strongly, and now the inquiries are above even our halcyon days of the lead up to COVID. And that is very much mirrored in shape by new signed cases, going up sharply, drop for COVID, and then a very, very strong recovery, of which this current year is part of course. On the number of completed cases, this is a rather different shape. The team were able to keep on completing cases and realizing completions on those cases, despite COVID. I mean, you can imagine the excuses that lawyers on the other side and directors on the other side. Oh, we'd love to meet you to settle this, but got COVID, can't do it. So there was very little impact on that side, which was fantastic. The realised revenues very stable actually as well. 21 and 23 there had particularly large settlements in those periods. An important caveat and note for everyone to understand is really on this average revenue per realised case. Now, when the huge increase in insolvencies happened after the insolvency laws came back to normal, it was the same time that the government withdrew £500 billion worth of financial support to UK businesses. The first companies to fall into liquidation were the small, weak, many call them zombie companies. I don't think it's disrespectful in any way. And so what had happened for us is that there was a huge increase in the volume of cases, as we've seen, but the size of the cases was on average a lot lower than it had been pre-pandemic. So if you look at FY24, the average realised revenue for each of the cases that we completed this year was about 100,000, but in the lead up to COVID, it was more like 200,000. So once the administrations, the larger cases, continue to recover, all things being equal, the mix in the insolvency world will go back to where it was pre-COVID. And as a consequence, our average revenues should be much closer to the 200 that we previously saw at that mix, rather than the 100,000 in these rather skewed times today. Cash has been a very, very positive story for us, and really the final court of appeal on any business model. So as you can see on the left, again, despite COVID, strongly increasing cash every year. On the right-hand side, the only difference there is this was the reported cash. There was a very, very big receipt we had in FY23. So just on the left, we've just excluded that to see the underlying trend. And this is on a net basis. So after we've paid the insolvent estate and they pay their creditors, the creditors usually includes HMRC, which is a jolly good thing for everyone. So that you then get Manolete retaining the cost that it needs to be reimbursed and its share of the profit on that case. Again, the only difference between the two graphs is that one big extraordinary settlement last year for 9.5 million. This is the so-called vintage table. It's not that easy to read nowadays, but it's quite easy to summarize. Key points are there are no cases outstanding earlier than the financial year 2020. So this fact that we bought the case, we control the case, and we drive it to settlement is a very unique feature of our model. If you were to look at other excellent litigation funders who do vintage tables, because their model is funding, they don't control the case, they will have quite a few cases running off 8, 9, 10, 12 years old. The second point is the very consistent returns here. So these cases on average over a very long period, 15 years now, have settled in just over 12 months. The return metrics, IRR, ROI, and money multiple are consistently very strong every year. So it hasn't been 1 or 2 or even 50 or 100 cases that have gone extremely well, outweighing lots of losses. No, it's been the granular wins in double quick time across hundreds and hundreds of cases. Two more specific areas of interest. First of all, bounce back loans. So just by way of background, and again, it's COVID. In June 2020, Rishi Sunak, when he was Chancellor, pushed out about 50 billion of government money to many, many thousands of SMEs in the UK, up to £50,000 loan they could take from their bank, and the government would guarantee it 100%. The trouble was it was done in a very quick period of time. The business people who were asking for those loans self-certified, which was like a red rag to a bull for a fraudster. And what the government's now found is, as it's been trying to collect in those monies, of that 50 billion, 8.9 billion has already defaulted, and the government's had to pay exactly that amount out to the banks because they've lost money on those. But there is another 30 billion that is performing at the moment, but obviously if the government don't take good enforcement action, that may be a very big outflow from an already stretched government balance sheet. So Barclays approached us a couple of years ago. They were the biggest distributor of BBLs. They gave us pilot to run over about 100 cases. They'd run a number of pilots, other banks run a number of pilots, and the returns on the other pilots on what money they got back using various methods were less than a fraction of 0.1%. That was told to us many, many times. Within a year of taking on these cases using our method, we generated £1.4 million. The recovery rate was about 70% on these BBLs. There's numbers still going on, so it goes up and down. But everyone's been absolutely bowled over how effective this has been. There was talk of other pilots starting. Barclays are going to send us a few more cases, but no more than a few. But the big change was the snap election that was called just a few months ago, again by Rishi Sunak, because of course this is the government's money, our money here. So the decision makers obviously were in Purda, and things are now paused while we turn to see what Rachel Reeves, the current Chancellor, will do. She's been very vocal, very focused on this. These are big numbers, and she is about to appoint, I think any day now, a COVID corruption commissioner, and we will learn what they intend to do to get these monies back, or at least some of these monies back. MANOLETE has presented very well to all of the banks, the British Business Bank, who really have been managing this, and I won't name which departments and certainly no names, but key stakeholders in central government as well. So they know exactly what we've done. They're delighted with it, but obviously, Rachel Reeves needs to do the very best thing for the British public. Finally, before I hand over to Mark, cartel cases. These really are very different. Competition cases. There was the truck manufacturers in Europe were price fixing for many years, 1998 to 2011. They were found guilty by the European Commission, biggest fine in history. What we did was buy the claims companies that would have had claims if they'd still been around. They were in liquidation, so we could buy the claims off the liquidator. Fairly novel approach. But on running this case, our strategy has been the total opposite of our core business. So we've got 400 cases going at the moment. I'm talking about 22 cases here. So we have piggybacked the first wave of cases. So Royal Mail and British Telecom went to trial. They were awarded 5% overcharge. They awarded a very high recovery on their costs. A second wave of cases coming through. We've issued our claims. They're currently stayed. There was an appeal by DAF on a single head of claim that in January this year was dismissed by the Court of Appeal. We don't know whether it was the Supreme Court, but we think that's pretty much the end of the road for the defendants. And it's costing them an absolute fortune in terms of legal fees to defend the indefensible. So that's where we sit there. And what's happened since that failed appeal is that a number of the defendants have contacted us, and we've started to trade counter offers and organise face-to-face sit-down settlement meetings. So that's very encouraging. Whether we get to an agreement, who knows? Will we get to agreement with all of the defendants? Who knows? Those that we don't settle with, we'll just push on to trial, and there'll be other settlement windows. But I think we're now moving into the final flushes of that process. I'm going to hand over to Mark. Mark, I'll leave you to control the slides, if that's okay.
Great. Thank you, Stephen. So a bit of a deeper dive into the financial numbers now. This first slide pulls out a few of our key financial highlights for FY24. Particularly wanted to draw your attention to three of these. EBIT profit of 2.5 million for FY24, as opposed to prior year where we made a 3.1 million loss. So that's a nice return to profitability. Secondly, gross margin of 39% against the prior year of 18%. So a significant increase in gross margin. And once again, cash generation remains strong for really the third year in a row, whether you look at net or or gross cash generation. So on to the trading performance. So the top half of the profits and loss. Total revenue of 26.3 million has been reported in FY24. That's up 27% on the prior year. And if you remember, it's comprised of two elements. There's realised revenue, which is kind of actual completions. And that was 24.2 million in FY24 and generated by a record 251 case completions. The other element of revenue is unrealised revenue, which is effectively the movement in our fair value. And that was recorded as a positive 2.1 million in FY24, was generated primarily from 311 new cases signed in FY24. And that compares to 263 in the prior year, so also a record number. Just looking at the graph on that slide briefly, you'll see the revenue composition. And for FY24, as we like to see, the majority of the revenue was realised revenue. So actually 92% of total revenue was realised. And obviously it's realised revenue which turns into cash. So that's what we like to see. Over the page. So just looking at the bottom half of the profit and loss, we made a conscious decision to increase headcount this year. And this obviously resulted in higher overheads. This positions the business, however, well for growth going forward and for both the increase in case numbers that we've seen and that we expect going forward. After these overhead costs, this resulted in a FY24 EBIT of 2.5 million, as previously mentioned. So a new slide on performance KPIs. This is just a selection of KPIs that we monitor as part of the business. And I think it really demonstrates the growth in operations over a 3-year time frame. The management team monitor these on a very regular basis. These are more actually. So just to share these with you. Over the slide to the balance sheet as at 31st of March. A few points to draw out on this slide. An element of the cartel case investment value has now been allocated to current investments. So you'll see that investment in cases is shown both as non-current and current. So an element of that cartel investment is now being shown in the investment in cases in current assets. And this is because we've now entered negotiations with a number of the truck manufacturers. Secondly, the trade receivables balance, if you look at both current and non-current, now totals 29.3 million. This is a significant number and is our visible cash collection over the near term. We've got obviously known collection dates for those trade receivables. Thirdly and finally, just looking at drawn down debt, which was 13.7 million at the end of March, with positive cash balances of 1.4 million, so hence a net debt of 12.3 million. And that gives us significant headroom of 5.2 million on our 17.5 million facility. So just in summary, the balance sheet's strong and it allows us to take advantage of the growth opportunities coming ahead. So over the slide to cash flow. As previously mentioned, cash flow remains strong in FY24. Gross cash collected was 17.7 million before any payments to IPs. This compares to 15.5 million in 22. And if you adjust the 23 figure to remove the exceptional case, the adjusted figure would be 17.2 million. So you've got a very nice upward and strong trend in gross cash collection. But the other important point from this slide is really that our net cash generated from completed cases in all 3 years is sufficient to cover our payment to employees and overhead costs, which is obviously something that we expect to be able to do each year, and we do. And hence any net borrowing is purely to fund investment in new cases. Final slide from me. Just a slide that you've probably seen before. This is the aging of our trade receivables, just really making the point that the bulk of our trade receivables are not yet due. The aging is very good, and there's only really a small tail of older outstanding balances. I'll hand back to Stephen to complete the presentation.
Thanks, Mark. So quite interesting new data on this bit. So clearly we're past the first 5 months of the new financial year. This is kind of statistically significant. So in those first 5 months, we've received the highest ever number of new case inquiries. Compared to last year, for example, we are 22% ahead, which is very good indeed. Second point is we continue to sign new case investments at a rapid rate. There's only been one further Barclays bounce back loan case in that 103, and this is therefore broadly in line with, again, not including BBLs, the record 146 in the first half of last year. Year to date, the team has quite sensationally completed in just 5 months 116 cases, which really is phenomenal. And if you add up the settlements value of all those 116 that the directors etc. have signed off, the aggregate of that is 11.8 million. So that's kind of building up your realised revenue for this current year, and that compares very favourably with last year on a like-for-like basis. So that instead of 116 we did this year, we did 93 last year, and the value of last year was just 6.3 million, with almost half what we've done in the first 5 months of this year, which is 11.8. So that is a very, very good outturn for the first few months of the year. Cash, the good news continues. The gross cash receipts actually, in the bank account on completed cases, 10.3 million. For the whole 6 months of last year, that was at 8.7. On a similar basis, the net cash, once you've paid the creditors their share, we paid the legal costs, we're at 6.5 million for the first 5 months, and that compares very favourably to 4.6 million for the whole 6 months of last year. So that's terrific. Strategy really remains very focused on UK insolvency claims. We're looking to build the portfolio not only in number of investments, but obviously also in size of investments. And if we can get that average revenue per case up from 100,000 to closer to 200,000, that would not need any further investment in overhead at all. That almost doubling of gross revenue would drop to the bottom line, and we'd start to look like our financial statements FY19, FY20, before this COVID pandemic hit. So as the market starts to reform back to its previous state, that presents a very strong opportunity. I've spoken about the cartel claims. They are now moving towards an interesting crescendo, and we hope to be completing some, if not all. And then, as I mentioned on the bounce back loans, potentially a huge opportunity, but there can be no promises. We've not been contacted by anyone in the Labour administration. I wouldn't expect to either. And until this COVID corruption commissioner has had time to work out the government strategy, we will patiently wait to see if we have an opportunity to assist. Actually, I might use this as my summary slide. So maybe we could turn to Q&A.
Perfect, Steve and Mark. Thank you very much for your presentation. What I'll do is I'll just bring your cameras back up at this point. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But while the company take a few minutes to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Steve and Mark, as you can see, we have received a number of questions throughout today's presentation, and if I could ask you to read out the questions and give responses where it's appropriate to do so, I'll pick up from you both at the end.
Super. Mark, there's a fair few financial type questions. I'll probably say an opening comment and then hand over to you if that's okay. So first question, in view of the unfortunate delay and need for you to change auditor, when will you be releasing an update for unaudited 6-month figures? So just to reiterate why that auditor change happened. So it was RSM. We'd been working with them very happily for a number of years since the IPO. Shortly before the year end, we purchased a £15 million headline claim from an insolvent company where an RSM insolvency partner was acting as the liquidator. So we sat down with the RSM and we both agreed actually this could taint the independence of them as an auditor. So we changed auditor. That had a knock-on effect. The audit reporting timetable, usually we report in June, and this is going to the answer to the question. We are now here in September. We will now be back to our normal timetable. So for the interims, which is what this was asking about, which is to the end of September, we will give a trading update as we usually do, a few days, a week or so, once we pass that date. And then the audited accounts, unaudited 6-month accounts should be due for circulation and announcement towards the end of November. And then for the year end in March 25, we will be announcing, all things being well, in June 2025. So back to normal reporting timetable. This one I will move on to Mark in a second. So Alex C says, regarding the bad debt expense, how much of the 1.4 million do, say, the top 5 parties represent? Last year, bad debt expense was similarly high. Were these different parties? Your provisions have risen significantly. Do you expect similarly ongoing drain on profits going forward? I'll leave the second part of the question for the minute. My one comment before I hand over to Mark, this can be a little bit misleading because the 97-98% of our cases are settled. The director has agreed to pay us those. If he doesn't, or if he misses a payment in his schedule, then we've got all sorts of restrictions on his personal house and all the rest of it. So our recovery on those is very, very good indeed. And one of Mark's slides spoke to that. Where we get a judgment of very rare trial cases, the director obviously hasn't agreed to pay us the £1 million. A judge has told him to. So there's much less certainty. We're kind of in the world of other litigation funders here. You have very big enforcement departments. We will be putting charging orders on houses immediately the judgment comes out in our favour, etc., etc. But we will do a very conservative, i.e. high level of provision against those amounts because it's not been agreed to. Mark, I'll hand over to you, but that's certainly
I mean, not a great deal to add to that, other than we do a very robust review of the debtor balance at both the interims and the year end, and we will provide against those balances that we feel are in doubt in any way. So the top 5 parties or the top 5 provisions were different from last year. It's difficult to say if the level of provisioning will be as high next year. It all depends on the behaviour of our debtors and the collection of our debtors. But as Stephen says, in general, our collection profile is very good, and we have assets behind those that don't meet their agreed payment schedules.
Mark, would I be right in saying that the ECL might come into this as well? So as the book grows, just automatically.
Yeah, there's also something called an ECL calculation, which is actually kind of a mathematical. It's like what used to be a general provision. So for each aging bucket of debtor, we provide a certain percentage based on our historical level of bad debt. So that's like a second level of provisioning behind the specific provisioning that we're required to do.
So as the business grows, that would automatically grow.
That will, as the debtors balance grows, that will automatically just tick up.
That's brilliant. We've got a few, so I'll keep it moving on. The other bit of the question, and maybe this is similar kind of area, in the going concern comments in the annual report, you note modelling a downside scenario included an elevated credit loss and assume write down of one high value case. Can you provide more colour on this, please? How large is the model write down? Thank you for taking my questions. Mark.
It's and I think the key here is it's a downside scenario. It's just something that the auditors like us to run in addition to our already prudent level of provisioning. So I wouldn't really like to go into what the level of the specific provision is. I don't think it's relevant. It's just to allow the auditors to know, in a worst case scenario, are we still okay?
Yes, it reminds me of a stress test at the banks.
Yeah, exactly.
Yeah. Okay, moving on. Again, I'll make a comment off this, hand over to Mark. 2019-2020 gross margin was over 70%, EBIT margin 50%. Will margins ever get back there? There's no need to complete risk question. I completely get it. It's the same kind of point. Yes, they will. And I hope this presentation has explained why. It's because the state of the insolvency market is still very skewed by the aftershocks of COVID. It's the very large majority of insolvencies are smaller zombie companies. It's taken a lot longer for the bigger companies to topple over. If Keir Starmer is to be believed, it's going to get worse before it gets better. So maybe we can expect some more of that activity, even on top of these buoyant times. So the returns that we make on bigger cases are far higher than the small cases. The corollary, really, if you're in a law firm or an accounting firm or an investment bank, if you're working on £100 million transaction, you'll get a fee of, let's say, £2 million. If you're working on a £5 million transaction, you'll get a fee probably of £150,000. So we're still missing a return of how the book looked before COVID hit us. But it's just a matter of time. There's no reason why it should not return to its previous profile. And the margin impact will be very direct from that. We have very fixed overhead cost base. And so the vast majority of that falls to the bottom line. And in the tough, horrible COVID period, the vast majority of the loss fell to the bottom line. So, Mark, I don't know if you want to add anything to...
I think that's spot on. No, that's great.
Super, thank you. Can you give a rough market size and growth rate with UK only relevance? Such a high market share is growth caps, right? Okay. So market size. This was documented by online by a paper by a chap called Professor Peter Walton, a professor of law at Wolverhampton University. He said that and I mentioned this in passing, that there are about 2,200 claims see the light of day when he was looking at the data. The value of those is about £1.5 billion. We're going back to, I think, 2010 data here. The data in this area is really very poor. And that had grown really exponentially in the kind of 8 years prior to that 2010 data set that he was looking at. All that one can add on to that is going back to the insolvency graph that I had on page 7, and you're seeing a huge increase in the number of insolvencies. And sure as eggs is eggs, every insolvency will have a potential claim, and probably not just one. So that's as good as I think anyone can get on the market at the moment. Sorry, this has skipped down to the bottom.
Yeah.
These are new. Oh, what's happened here? I think the other thing. Here we are. Growth. Yes, going back to that pie chart. The growth isn't just about the growth in insolvencies and the value of insolvencies. It's also about taking market share off the lawyers doing it on a no-win, no-fee basis. Now, the third-party funders, all of us, have been eating into that year by year. We're now, I think, about 20-25% and no win, no fee. But there were something called the Jackson reforms a few years ago, and that makes no win, no fee really very difficult to work for insolvency. So we are very confident that it's one-way traffic, and that yellow in that pie chart will just get bigger and bigger and bigger. Moving on, Mark, one for you, I think. How much is spent on external legal fees that is not expensed in the P&L but capitalised as part of the investment? Today's account show a transfer of £1.5 million for 2023 on the cartel cases alone. I don't think that's right. But anyway, yeah.
No, that last bit wasn't right, but it's right that we capitalise our legal costs as well as the carrying value of the case while the case is live, and then we recognise both costs and revenue in the P&L at the point the case completes. So there are kind of single figure millions of external legal fees capitalised on the balance sheet, but there are tens of millions of fair value that are about to be turned into revenue. So that they will be recognised together in the profit and loss at the same time.
And I'm pretty sure that every single litigation funding company treats it exactly that way. Yeah. Question here by Simon B. Can you explain why your net debt increased to 12.3 million from 9.9? Also, do you have any plans to cap the amount of debt you take on? Thank you. Yes. So, Simon, you would have obviously picked up two key points as we went through the presentation. Number one, a huge increase in the number of cases. That obviously costs money to buy and run those cases. And then we increased the headcount to cope with those. We added a few extra lawyers, and that of course adds to cash outflow. What I would point you to is that when you look at the net debt in the half year of FY24, it was around 12 million itself, maybe 12.1 if memory serves me right. So it's only gone up a smidge in the second half of the year, despite buying this huge number of cases and more on business development costs, etc. So I think the fact it's stabilised there is a very good sign. We have had, as I showed on the current trading slide, a huge amount of organic cash come through, 10.3 million. We've been repaying HSBC rather than taking more off them recently. So I think we're in a very good place as far as debt management is concerned. I think we've answered that market share one. Yeah. We did the illegal fees. This I thought was. I didn't agree with this, but I'll read it out anyway. And just in order to be fair, I fear that in a recession, the current government might be willing to re-establish the pandemic period restrictions on the insolvency process. Any thoughts on this? Well, there's just no way that would happen. Number one, people aren't dying, and that's very important. I did not say that flippantly at all. Number two is when you listen to Keir Starmer in the Garden when he spoke, when you just listen to Rachel Reeves, our governments and many governments' balance sheets are hugely stretched at the moment, and yet they've got to pay for social services, defence, etc. So, as I mentioned as we went through, when we send half of the net proceeds back to the insolvent estate, yes, the liquidator will take his fee, but the remainder will be going to the creditors. And almost always creditors are led by HMRC. And in fact, they have priority now. They've gone back to be a superior creditor. Now, that money is going to HMRC, which is the public purse, which is the education budget, which is hospitals, which is defence spending. And this is the huge importance of what Manolete does in the wider society. So this is just explaining what I said, why I do very vehemently disagree with that comment. Has the increase in staff numbers reached a plateau? Not necessarily so, Peter. It is an excellent question. Thank you. We have got 15 in-house lawyers. That's a key critical constraint on the number of cases. The way we work it is that once they're fully up to speed, every in-house lawyer can manage about 35 cases at any one time. So that gives us current capacity to be running 520 odd cases today. Mark, I think live we've got at the moment
418 at the year end.
418, so we've got a nice headroom to build into before we need to think about any more headcount coming in. But if in 6 months' time we're at 500 live cases, which who knows. We will want to have been planning to increase headcount to give us that flexibility and capacity is the right word.
I suppose it's fair to say we're not expecting a significant increase in headcount. Any increase would be gradual.
Incremental. Yeah. And actually always has been really. David B, good question. Will the settlement of the cartel cases go all in one go or separately with each counterparty? The latest thinking on this is it will be sequential. I mean, there are big numbers. There's only about 7 different defendants on this. So, and they're all very, very big companies, Mercedes, Daimler, DAF, etc., Renault. So it looks like it will be sequential, but they say they're not talking to each other, but they're facing so many claims on this, and I'm rather sceptical when I hear that. So, and it's just a gut feel from me, and I could be wrong, but I think settle with 1 or 2. I suspect those the 1 or 2 who haven't engaged with us at that stage may well come through. Yes, someone asked me, and these questions jump around an awful lot. So someone asked about time to yes. So we answered that. So are you releasing revenue and PAT estimates for FY25? So obviously we don't release any forecast. That would be against the rules, and I think even the Financial Services Act. However, our brokers, who are excellent at Canaccord, Portia Patel, and Justin Bates, they will be initiating coverage, as Mark and I understand it, over the coming weeks ahead. They're doing an awful lot of really good work across the board. So I think that will emerge. So hopefully that answers your question. I think the final one here, again, David, the RSM related claim is of significantly higher value. Have you got other large claims in the pipeline? Well, not just the pipeline, David. We've got many that we're working on that are not dissimilar in size to that case. Now, just because it's got a headline value of 15 million doesn't mean we're going to get 15 million from it. Of course, back to the point about the net worth team. If people haven't got money, it doesn't matter how big it is. It's worth nothing. So yes, we, as I said, as we're going through, we picked up 20 of not dissimilar, so at least 7 figures, if not 8 figure potential in the second half of this financial year that's just gone. We picked up 9 in the first half, so the direction of travel is going very well. So yes, hopefully that's obviously I can't talk about live litigation, but hopefully that gives you a flavour of what's going on.
Perfect. Stephen, Mark, thank you very much for answering those questions. You can from investors. Of course, the company can review all the questions submitted today, and we will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you their feedback, which is particularly important to you both, Stephen, could I just ask you for a few closing comments?
Sure. Can the viewers still see the slides?
Yes, they can do.
Wonderful. Okay, so as I said, I just thought I'd use this as a wrap up. So we are the UK's leading insolvency litigation financing company. It's a unique model in the wider world of litigation funding, but a very different model because we buy the claims and the others don't. They fund other people's claims. We have significant expertise and nationwide coverage. Some of you would have seen a subsidiary of Rosenblatt Solicitors, Lionfish, and then their insolvency offering called Islero tried to compete with us. They signed 1 case in a year and then they stopped doing it. And the cases they bought in other sectors led to 4 losses in a row, and that seems to have disappeared, as I understand it, from Rosenblatt at least. So we've got expertise, a very wide and a very effective moat, which is why I talk about that example. The market drivers that are very strong tailwinds behind the business now. The number of insolvencies are growing at a very strong rate, and as the number 1 company in this segment, we are positioned particularly well to benefit from that. The durations of the cases are very short. The cash generation track records, I think Mark elucidated, is very strong now. The operational leverage means that as the case sizes increase now, the profitability will drop very quickly to the bottom line. And I find the vintage table always leaves me feeling very positive about the business. It's because of this very long, very granular, and very consistent track record of delivering very high returns. I know that the last few years have been very challenging for this company, and that is reflected in the share price. And I'm a very large shareholder personally, so it hurts no one more than me on a value basis. It was extraordinary what happened in COVID. It was, as the judge on our board said, was wartime legislation, similar to what the government did in World War I and World War II, to suppress insolvencies, to stop mass employment. That is all now behind us, and the business, as you can see from these graphs, has rebounded incredibly strongly. Thank you very much indeed for your time again.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close the session? It should now be automatically redirected. Provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MANOLETE Partners PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.